Good morning, everyone, and welcome to our DAT IQ Weekly Market Update. This is our update for August 15th, 2023. I'm Ken Enemo, Chief of Analytics, back from vacation. I survived the blast furnace that is the state of Florida, unscathed, thankfully. I'm joined by Dean Croak, who's our Principal Industry Analyst, and Ibrahim Bayan, who is going to educate us all about the happenings in the warehousing market this week. Good morning, gentlemen.
Good morning, Ken. Welcome back.
Thanks. It's great to be back, actually. It's very nice here in Ohio today. How are things down your way, Ibrahim?
It's blazing hot, and when it's not hot, it's storming. It's been that way for the better part of the last couple of weeks here.
You're in Atlanta, right?
That's right.
I love Atlanta. A lot of good restaurants down there, good barbecue. I pretty much plan all of my excursions around food. I'm going to Boston later this week and just already plotting out how many lobster rolls I can fit in a 3-day work trip. All right. So for those less familiar with the show, we're here every Tuesday at 10 a.m. Eastern, talking about trends we're seeing in the freight market. We're typically lucky to have a guest, and this week's guest, I'm really excited about, a friend of the show. You want to do a little bit of a short intro for those who may be new to the show since you last came on?
Sure. So my name is Ibrahim Bayan. I'm the Director of Industrial Real Estate Research here at Nuveen. Nuveen is one of the largest global asset managers in commercial real estate. And so we invest across various classes, so apartment buildings, retail, but my specialty is in warehousing and industrial real estate.
Very hot, timely topic right now, much like the weather in Atlanta. So we'll bring Ibrahim back towards the end of the show to touch on that when we get to our question of the week. And I'm going to dive into key points of this week. But before I do, for those that might not stay all the way to the end, I wanted to do a plug for DATCon happening in October. It's October 10th to 12th in Houston, Texas. I was able to bargain with our marketing team and get y'all a discount code. So when you go to register, if you enter all lowercase GOBUCKS, GOBUCKS, you will get a discount code for DATCon, and it will get you in, and it's going to be a great show this year. We'll talk more about the end, what's going to be included, but I wanted to say that at the beginning of the show. So key trends we're watching. Spot rates dropped close to 2019 levels. Anytime we see a short-term spike in fuel, we will see downward pressure in base line haul rates. It's just sort of the mechanics of how the market works because things are negotiated on an all-in basis. So that means that brokers are able to generally charge a little bit more to the shipper, but carriers aren't generally able to negotiate more for the fuel. So you tend to see a bit of an expansion in the gap there. Contract rates are typically following that spot rate on a 4 to 6 month lag. We've got active reefer and van rates continuing to drop, but the rate of drop is declining. All signals of a plateauing market, poised looking for some reason to rebound. And those replacement rates are turning into low single digits after a prolonged period of being down double digits. The Michigan State Ton Mile Index fell 1.3% month over month and 2.1% year over year. And then the Cass July Shipment Index, that report is authored by friend of the show, Tim Denoyer, over there at ACT Research. That fell 2.2% month over month in July and 8.9% year over year. I'm going to turn it over now to Dean for our market update. Dean?
Welcome, everybody. The long-form version of today's market update will be available this evening. Just go to dat.com/market update, where you'll find all of the content and charts. So let's get started with the van load-to-truck ratio. Our spot market volumes follow a relatively flat seasonal pattern from now until October. Certainly the start of October, volumes are about 2% below the pre-pandemic average for week 32, to give you a sense of where they're sitting. So we're about on par with what we'd normally expect. About 11% higher than 2019. Carrier equipment post still pretty high. Load-to-truck ratio down slightly from 2.94 to 2.70. Let's move over to the refrigerated load-to-truck ratio. After surging the week prior, reefer spot market volumes dropped back by 16% last week, now sitting just 2% above 2019. Carrier equipment posts were mostly flat. Load-to-truck ratio down slightly from 5.04 to 4.3. Onto the flatbed load-to-truck ratio, flat market spot volumes down about 31% in the last month, down 16% last week. That's the lowest we've recorded for week 32 going back to 2015. Load posts are about 61% lower than last year. Carrier equipment post mostly flat last week. Load to truck ratio down to 5.63. In the previous 6 years, the only time the flatbed load to truck ratio was below 6 was during the early days of the pandemic, when we were going through the global crash in demand. Onto market condition index for dry van. Looking at some of the markets in the southwest, sweltering heat last week. Outbound capacity was very tight in the Flagstaff market. Rates up 32 cents a mile to $1.97. Albuquerque loads were paying carriers about $3.10. That's about 12 cents a mile higher than last year. A lot of tight capacity in the West Virginia market last week at $1.94 for outbound loads. Rates were identical to 2019, up about 8 cents a mile last week in the larger Charleston market. Rates also increased by about 23 cents a mile to an average of $1.87 after decreasing to the prior 2 weeks. Hunting loads paid carriers $2. So some pretty good loads out of the West Virginia market, not a big market. Indianapolis capacity was tight, rates up 1 cent per mile to $1.82. State level rates in Indiana sitting around 6 cents a mile higher than 2019 at $1.93. Having a look at the refrigerated market condition index, only 2 of the 19 produce growing regions reported a slight shortage of trucks last week, according to the USDA. Those were in Delaware, Maryland, and the eastern shore of Virginia. Slight shortage of trucks, mostly for loads of watermelons, where we're in the tail end of that season. Also, some tight capacity in southwest Indiana and southeast Illinois. Trucks were in demand for watermelons and cantaloupes. Outbound reefer rates averaged $2.46, substantially higher than our all national average for all temperatures. Outbound spot rates in the meat patch in Kansas and Nebraska, rates up 26 cents a mile to $2.58. In the Hutchinson, Kansas market, reefer spot rates averaged $2.63 last week, up 47 cents a mile in the last month. Capacity, of course, continues to tighten in Wisconsin. Potato harvest is underway, as we mentioned last week. Outbound loads averaging $2.62 in Madison, up another 10 cents per mile last week. Over to the flatbed market condition index, at $2.40 a mile, outbound rates in Michigan are very close to 2019, following last week's 22 cent per mile increase. Flatbed rates surged last week in the larger Grand Rapids market, up 86 cents a mile to an average of $3.23. They bounce around that level over the course of the month, so I'm not reading too much into that spike in rates. I think they'll settle back down next week. Short haul loads east of Detroit out of the Grand Rapids market were $23 a load higher, averaging $7.43 per load, while loads to nearby Fort Wayne, Indiana were flat at $6.55 per load. In the Pacific Northwest, solid gains were reported in Portland for carriers, rates up 12 cents a mile to an average of $2.36. At the state level in Oregon, rates are averaging about $2.65 per mile, pretty good compared to prior years. They're almost identical to where they were in 2019. So let's have a look at our year-over-year look at spot rates. Let's start with dry van. After being mostly flat in May and June, dry van line haul rates dropped 12 cents a mile since the July 4 break. Last week, they were down another 3 cents per mile at $1.59 per mile. Dry van line haul rates are just 4 cents a mile higher than in 2019. On our high volume lanes, on our top 50 dry van lanes, rates average $1.91, about 32 cents a mile higher than the all national average. Having a look at the refrigerated market, year over year look at spot rates, after being flat in the prior week on higher volumes, reefer line haul rates dropped just over 2 cents a mile to a national average of $1.95. Spot rates are now 34 cents a mile lower than last year, sitting about 7 cents a mile higher than in 2019, as you can see from the chart. And wrapping up with flatbed, flatbed line haul rates have dropped 25 cents a mile. We're about 11% since Mother's Day. Last week, they were down another 5 cents per mile, averaging $1.95 nationally. The national average rate is under $2 a mile for the first time this year, and about 39 cents a mile lower than 2019. Compared to 2019, spot rates in the flatbed market are about 6 cents per mile higher. And that's it for this week's market update. Remember, dat.com/market update. You'll find our weekly report tonight. And with that, it's over to Ken for the short-term forecast.
All right. Thank you, Dean. So as always, I'm just going to pull this up here. We are going to start with short term. There we go. Lost my tab for a second. Let's just level set on history here for a second. So the blue line is the 7-day weighted moving average going back to March 1st, 2023. These rates exclude fuel and they're long haul only. And that'll be the same across all three equipment types. Like I said, we start with van, and then you have 4 forecast models. The green one is Raycast. That's what's in all of our products. The red is a short-term model, which more heavily weights the most recent data. And then you have a gray and a yellow, which are blends of different models that kind of cut the difference between long and short-term weighting. And as you can see here, the models, at least the 2 primary models, could not possibly be in more of a disagreement. Raycast has us pulling out of this drop, which is what you would expect seasonally as we head into, when kids across the country are going back to school, we start to see the market rebound a bit. And then it'll continue to gain steam as a lot of the ocean freight moves inland for retail peak this fall. The short-term model is not buying it. It's continuing to drop, probably due to some of the recent downward pressure being expressed in the fuel markets. Let's move ahead a slide and go to reefer. A little bit more agreement here. This is when you typically start to see a lot of refrigerated goods moving. So the short-term model isn't necessarily as pessimistic, and Raycast, if you would kind of compare it to dry van, is a little bit more optimistic, believe it or not, as we head into the fall. And again, this forecast window only goes through, it only is about a month, 35 days, so it only goes through mid-September. It's not showing us too much into the peak shipping season yet. But over these next couple of weeks, we'll be really watching where this forecast ends up, because we're going to start to see more and more of what peak might look like. And then let's move ahead to flatbed. Our last chart for this week, pretty much in agreement with some differing in levels. Raycast has us pulling out of this drop a little bit. The other 3 models are pretty much down and to the right to varying degrees and increasing levels of downward slope. There's really not a lot of technicals underpinning what's happening in flatbed right now. This just seems to be the market trying to find some stable point based on lackluster demand and an abundant supply of capacity. So we are going to bring our guest back this week and get to our question of the week.
Yeah, thanks. Welcome to the show, Ibrahim. One of the things that I couldn't help but notice here in Salt Lake City yesterday was the abundance of brand new but empty warehouses. But the question I wanted to ask you was based on some reporting last week about the logistics-heavy region of the Inland Empire that we talked about on our show when you were on a few months ago. The vacancy rates jumped to 3.8% in the second quarter. That's up from about 1.2% a year earlier, and that's still below the nationwide vacancy rate of 4.8%. So the question is, do you think California's warehouse vacancy rates, they're increasing, are indicative of the rest of the country?
So to an extent, yes. There is a broader trend of just rising vacancy in the industrial sector this year. And part of it is because of supply, but also it's just, there isn't quite as much demand as there was. You can step back a little bit. If you looked at 2021 and 2022, those were among the strongest years on record for just like warehousing demand. So if you looked at like net new demand in the sector, massive amounts of tenants moving in, not as many moving out. And so you saw vacancy rates just drop very consistently. But the economy's pulled back this year. And so you don't have as much demand. And at the same time, there's been just a crush of new supply coming online over the course of the past couple of quarters. And so that combination leads to rising vacancy. And so Inland Empire is part of that. There is some uniqueness to what's going on in Southern California. There are some broader issues revolving around just like global trade, particularly trade with China, and what's been going on there that drive demand in that region, that I think make their position a little bit more unique. But I would characterize the broader industrial sector as just like, it used to be at record low vacancy, starting to see more supply than there is demand, and vacancy is starting to rise as a result. So in a sense, Inland Empire is part of that, but there are some very unique things going on specific to that region. Yeah,
it's some of the other markets that I watch, like Phoenix, I've talked about the Phoenix market for quite a while. Any sense that growth there is slowing down, because now they've got water problems as well as that market has expanded? But one of the things you said on our show last time was the reason for growth in that market was available land. So what's your sense about that market?
That's right. And I think long term that still holds true. But again, like most of these markets, you find some weakening in the amount of demand for new space this year. Like the reality is, like if you were a a retailer or a manufacturer that was previously considering expanding their warehousing footprint, like they thought they needed more warehousing space, 2023 probably served as a bit of a pause for your plans. Like the reality is demand isn't as strong as it was last year. There isn't as pressing of a need to store more goods anywhere because demand isn't as strong. And so you just don't see as much inventory building in general this year. Now, I would characterize all this as sort of like short-term kind of dynamics, right? Like I long term, I still think there are a lot of things that drive demand in Phoenix. One of them being just like, land's pretty cheap. You can expand fairly easily out there. But the other thing is just, it's a good regional kind of location to service that Western region. So if you set up a big distribution center in Phoenix, you can reach a number of major West Coast markets and Phoenix. And so there are long-term kind of demand drivers that I think make it still a very attractive market. But just short-term, 2023, probably a year where many of these potential tenants are just putting pause on things.
What about the Fort Worth market? That's another one that we've seen a lot of growth. We've seen that market change its dynamics in terms of inbound and outbound freight volumes on the spot market. So is that another market that you see?
So Dallas-Fort Worth is probably the fastest expanding industrial market, at least in terms of square footage. There are some smaller markets that I think are relative to their size are expanding pretty fast, like a Savannah. But in terms of the major markets, Dallas grows quicker than any. And there's a good demand reason for that. Like setting up shop in the Dallas market allows you to capture all the Texas markets. There's major air hubs that bring freight into Dallas-Fort Worth, which then need somewhere to store. From there, you can kind of take goods and ship them through, up north to the rest of the country. So there's plenty of demand drivers for why. And Dallas is a big metro in its own right? Like it's also just a lot of people living there. Yeah. So there's a lot of demand drivers that drive things. But very similar to a lot of southern markets, it's also pretty easy to build in Dallas. There aren't a whole lot of zoning restrictions, at least not compared to some of the other more difficult markets to build in. And so companies are looking to set up shop there. Again, rapidly building, particularly in terms of like bigger, 500,000 square foot or above kind of buildings. Companies are really looking to set up massive distribution centers in that area, and it's a good place to set up shop.
Yeah, it's a hot market when one of the large Class 1 railroads start to run a short line rail service from Houston to Fort Worth.
That's right. That's right. There's a if you ever drive through Dallas, once you hit like the outskirts of the city, it's just waves upon waves of warehouses out there. Wow. There's not a whole lot of trees. It's very hot there, but there are a ton of warehouses that are just kind of setting up shop. And around the airport's very popular area. There's kind of like a developing area in Alliance, sort of like the Alliance Gateway that's coming out of Dallas-Fort Worth, where you sort of have a bit of an inland port situation along with air freight that comes into that area. So very popular for tenants.
Got it.
How are interest rates affecting warehousing costs?
So interest rates in terms of fundamentals, they affect things sort of secondarily, right? Like higher interest rates affect different areas of the economy, and that will affect sort of warehousing demand and rates that way. So like a good example of that is like housing and construction. There are a lot of warehousing, especially in sort of medium or smaller sized buildings, is tied to like the housing market. So when you see higher interest rates, you might find less housing activity. Although this cycle hasn't been as terrible as I think I would have thought ahead of time. But yeah, then you start to see like weaker, demand for warehousing as a result of that. The big impact of interest rates on just in broader commercial real estate is just on pricing and values. Like if you buy and sell commercial real estate, higher interest rates basically require higher cap rates for warehouses when you go to sell them, and so that has like a negative impact on like the value of these buildings. Not that dissimilar to say like residential housing, that if you have higher interest rates and people's mortgage payments are higher, then the value of these things it puts downward pressure on the value. So that's in my world, that's the big impact. Is like what are higher interest rates doing to values? But in terms of fundamentals, it all kind of depends on how big of a bite it takes on economic activity. And warehousing, very similar to transportation, is sort of like a derived demand from that. Like if the economy is kind of doing okay, then you'll have demand for warehousing and you'll have demand for transportation.
Yeah, that's very interesting. I mean, it's for the first time, and again, this is all super anecdotal, but in my, like the I-80, I-76 corridors that come through Ohio, there was just tons of warehouses going up over the last 5 years. And it's really the first time I've seen vacancies and like heavy advertising from those locations. There's a brand spanking new one right on US 8 North, or Ohio 8 North, that right before you get to the I-80 corridor, and it's mostly vacant and has been for the better part of the last year. So it's kind of wild how quickly that's changed.
Well, it's part of the nuances of warehousing, and one of the side effects of the fact that it just takes a long time to build these warehouses. Like it's very different from like the transportation side, where like if rates get high enough, you'll just start to see capacity come into the market.
Yeah,
and people will ramp up hiring. But like on the warehousing side, when rates are higher, people get excited all the same and they want to expand. Like developers, they'll look and say like, oh, rates are high, let's go build some more warehouses. But it just takes a long time. Even in good times, it takes about 4 or 5 quarters to build, a new warehouse. And over the past couple of years, it's been even longer, just because of like supply chain disruptions and delays. I mean, there are components in warehouses that still there's a significant lead time before you can get the product that you need. And so what's happening now is like, people that made plans in 2021 and early 2022 to build a warehouse when rates were looking great are just now delivering the space. And they're doing it in an environment where there isn't quite as much demand because the economy isn't doing as well. And so, particularly when you're looking at like bigger size buildings, there are a lot of them that were built speculatively, like, built without a set tenant in mind, just on the assumption that if you build it, somebody will like it and will come. And they kind of entered 2023 in an environment that's not quite as strong. And so it's not all that surprising that you start to see some of these buildings that sit vacant for the time being. Yeah. I still think there's broader long-term kind of tailwinds that don't make it a sort of a long-term problem. Companies are still looking to modernize their supply chains. E-commerce still drives an awful lot of activity in warehousing. So I think, once you get past whatever economic uncertainty there is, I think, you'll start to see these buildings get filled up. But for the time being, it is quite a headwind.
That's an interesting point on the lead time. When I was asking around locally about some of these large buildings that were seemingly completely vacant, what I heard from a lot of folks that are on the ground is that basically the infrastructure bill threw a monkey wrench into things, in that there was a really, really large highway expansion project that got commissioned about halfway into the construction of that warehouse. So it's going to make traffic down from the main interstate corridor a lot more difficult for the next few years. And there's a lot of folks that they got real skittish about that, just due to the in and out on some of those warehouses due to that. So that point about the long lead time, a lot can happen between when you break ground and when you ultimately need to fill the vacancy.
That's right. And typically in the industrial space, when you build a warehouse, there's a good chance that you may have already pre-leased it. Like, on average, when you're starting just like development, maybe like 40% or so have already have like a lease in place. So it's like a company saying, okay, we want to expand here, and they partner with somebody to develop the warehouse, and they set up shop and they move in. But when rates get really high, when rate growth gets really high for these warehouses, it encourages sort of speculative development. You just say like, look, we can get X amount of money per square foot for a warehouse. And they're growing really quickly. That rate is growing really quickly, and so if we don't have a tenant right away, that's fine. The demand's still pretty strong, and you can find somebody to fill it. And that's sort of the assumption that you're under in 2021 and 2022. There was a lot of talk in the sector, in those years about some more permanent shifts in just like consumer behavior and just like the need to expand due to e-commerce and things like that. And it hasn't quite materialized as strong as I think a lot of developers would have assumed. So they kind of enter into, by the time the building gets built, they're entering into a much softer kind of demand environment. It's not a terrible demand environment, but it's just weaker than what it was when they began.
That makes a lot of sense.
Two-part question just quickly before we wrap up. Governor Jay Inslee up in Washington State recently passed a bill or a law that mandates shippers require restroom access. So it's now a law in one state. There is a bipartisan bill before Congress. Second question is about automation on these new warehouses. Are they different? So two-part question about has the restroom access issue bubbled up to your level as an emerging trend when they build warehouses, and what sort of automation are they seeing in the new warehouses?
So I'll take the second part first on automation. Increasingly, you're starting to see automation being built into these warehouses. I wouldn't say that automation is necessarily the main feature that drives sort of demand. Like typically when companies think about modernizing their warehousing operations, it's more about like having higher clear height ceilings, like instead of having like a 22-foot ceiling, having a 40-foot ceiling, which allows you to stack pallets a certain way and put more space, more goods in there. There are ways to optimize sort of your operations, particularly for things like e-commerce fulfillment, that deal more with like the docks and how those are set up in the warehouse, and like the clear heights and how high the ceilings are. And automation is a broader part of it that I think will be a much bigger deal in the future. A longer term challenge that like the industrial sector, the warehousing sector has. It's very similar to transportation. Is that they're having a hard time staffing some of these warehouses. So you might have like a good location that you that you want to set up shop in, but the labor market is so tight that once you set up, it's very difficult to fill that warehouse, and it puts upward pressure on wages and how much you have to pay people to come in and work. And so automation, longer term, I think fills some of those needs by reducing the amount of like physical labor you need. In order to kind of bring to operate some of the warehouses that come up. The first part on local legislation, I mean, legislation at a local level always plays a role in warehousing and warehouse development. I would categorize this as one of many different ways that sort of legislation can play a role. There are like ESG mandates that are still pretty local at least in the U.S. Because we don't have like there's not a whole lot of national sort of environmental policy that's in place, and so it's sort of locally, state by state, you'll find different pieces of regulation that come up. There are always local ordinances on like the amount of noise pollution that you can have when you're allowed to operate some of these warehouses. There's zoning regulations as to like can you get land zoned for this kind of use, and there's a general tension in the warehousing space between the consumers that sort of want the convenience of having warehouses that are pretty nearby, but they also just don't like to live near warehouses. If you've ever lived near a warehouse, one of my first house was pretty close to a warehouse. It's annoying. I mean, if you're by one of these warehouses that run 24/7, there's always trucks going in and out. There's an awful lot of noise, and so people don't like that. And so as a result, there's legislation that comes on the heels of that, and there's typically local pushback when warehouses get too close to where people actually live. But it's always a concern when we're looking at warehouses to either purchase or develop. You have to sort of consider what the state of local legislation is.
Okay. Got some good questions there, Ken. Do you want me to dive into some of those?
Yeah, let's run through a few of those and then wrap up.
Yeah, so Ibrahim, this is a good one for you from Fermented Food Holding Logistics. With rising vacancies, why is the cost still rising for warehouse rates, especially some of the 3PLs in the refrigerated market?
Well, I mean, I would say warehousing rents in general are still rising. Keep in mind that vacancies that are rising it's an important development, but the reality is like vacancies are still relatively low by anything that you would consider normal. So to put into some perspective, like historically on average, the industrial sector has something like 6.5% of its space vacant, right? And that's what you would consider just like a normal functioning warehousing market that has about 2% warehousing rent growth every year. And right now, the warehousing vacancy is below 5% still. Even with vacancies rising over the past couple of quarters, you still have vacancy in the sector that's under 5%. And so the warehousing market is still very tight in most major markets, and that puts upward pressure on the rents still. Like you would have to see a more prolonged period where vacancies are rising further, when you start to get closer to vacancy rates that are normal, where there would be less. You start to see sort of downward pressure on the rents, and then downward pressure on sort of the warehousing costs that some of the logistics providers feel.
All right, so B. Bandy asks, would a strike, this is probably for you, Ken, just as much as Ibrahim, would a strike with the big three in the auto industry in September have any major impact on rates? I guess
on my end, probably not. I mean, a short-term event like that typically isn't going to alter long-term plans. I mean, consider that like most warehousing leases on average are going to be around 5 years long. And so when thinking about sort of expansion plans or where you need to set up, I mean, of course, it hurts the tenants that are in there temporarily, but nobody's going to sit there and say, like, well, there's a strike now, so I need to drastically alter, like, 5 years down the road where I need to be locating my warehouse. If you start making sort of strategic decisions as a result of the strike, so if you step back and say, like, look, this strike really burned me, I need to start rethinking the way that all of our operations work, then maybe you start to see things that filter in that way. But my general view on most of this stuff is that, like, these kind of one-time events are too short-term to really drive long-term warehousing decisions.
Yeah, I mean, I don't know. Most of the labor issues that we've gotten frothed up about haven't actually materialized into anything over the past year, other than the Canadian port strike that happened for a little brief period of time. So I'm not going to get too concerned about it right now, but it would certainly impact a lot of freight in that tier 1 area of the Midwest, right? There's an entire transportation sub ecosystem that operates around the big three. So, all right. What else, Dean?
Some shout outs. Are we ready to wrap up?
Yeah, let's wrap up.
Yeah. Sales chatter tomorrow. I'm on with Dan Deegan, Day-to-Day Wednesday, talking freight, 11 a.m. Eastern. Robert Ross is on Landline now, as always, Wednesday, 7 p.m. on Sirius XM Road Dog Radio, Channel 146. Freight-Mind podcast, Chris Kaplis has got Seth Clevenger on talking about the transport topics, Top 100 coming up. We've got Alex Leslie from ATRI talking about the operational costs in trucking. Ken's already mentioned DATCon, October 10 to 12. Don't forget CBS Freight Safety Week is next week. Expect some service failures as carriers get caught up. That's August 20 to 26. And with that, it's back to Ken to wrap up the show.
Yeah, thanks, Dean. So again, I'm just going to keep harping on it. We got DATCon coming up. We've already got a ton of people registered. It's going to be our biggest event by far. A lot of great speakers, a lot of great sponsors. I highly recommend you go to our website and check that out. It's a user conference, so it's not going to be one of those events where you're kind of the only broker, carrier, or shipper being kind of swallowed up by vendors, TMS, visibility. Those are great too, but this is a pure user conference. So you have to be a customer to attend, more prospective customer, and you'll get to learn best practices, market insights from other users, from other customers, from other players in the space. So with that, we're going to sign off. I want to thank Ibrahim for joining us. This is always a great conversation. We'll probably be seeing him again in the next quarter to wrap things up at the end of the year and see what the outlook maybe is for 2024. Could be a great topic to have you back and talk about the 24 outlook for warehousing. And with that, we'll see you next Tuesday at 10 a.m. Eastern. Bye, everyone.
Bye, everyone.